Hello, everybody. This is a video that I'm probably going to get a little emotional about. I'm probably going to swear a lot. So if you're sensitive to those kind of issues, you better turn it off now. That's a warning. And if you're sensitive to believing in bullshit corporate finance, you better turn it off right now. And maybe if you believe the kind of crap you learn in business school, you better turn it off now. This is a video on country risk premiums. And if there is any kind of crap, this is just amazing. And there's I'm sure, a very, very nice man called Damodaran, Damodaran, who makes analysis of this. And he's very famous, a whole lot more. Well, I'm nobody, whatever. I don't want to compare him. I mean, he comes up with these risk premiums, and that's what I'm going to talk about today. But I'm going to go through some slides first. The first thing I'm going to tell you about is when the cost of capital is the target IRR, if we're talking about project finance or corporate finance. It's how much IRR you need to make an investment. And I'm going to show you that over a long period, whether it's corporate finance or project finance, a small difference in IRR makes a very, very big difference in how much money you get. A gigantic difference. So when you start throwing around country risk premiums like 2%, 10%, 5%, it is enormous in terms of how much people have to pay for infrastructure, hospitals, electric power, beer, anything. If they have to pay this gigantic premium for God knows what, it's expensive, and it ends up to be corruption. It ends up to be corruption to people in London or New York who start stealing money from places like Africa who have to pay these premiums. Oh, see, I'm already emotional. I'm going to start by talking about just IRRs now. I'm going to start by saying, well, IRRs on stock prices. I'm not going to open this file for once, but here's the IRR from 1990. If you make an IRR of 7% in the US or 6.78% in Germany, notice that it kind of tracked about the same. And then here's the tax law. Here's the, I think you can explain a lot of this by just the change in the tax law. You would have invested one USD, you would have got 8.89. Now this is euros, so it's a little different, but you got it 6.56. That's a lot of money. One goes to 8, one goes to 6. It's a long time, maybe 1990 to, what is that, 30 years almost or something, okay? And then I will talk about Mr. Bezos, who paid 38 billion to his nice wife. She wanted a little more, but she took 38 billion. And his IRR was 38%. Now that's a lot. Apple's actually is more if you start in 1997. But look, okay, if you invested in the stock market and made a 6% IRR, you ended up with 3.72 for every one you put in. If you get these high IRRs, look how it balloons. That one becomes 1,100 in Amazon, 401 in Apple. Okay, that's how you become the richest man in the world and pay your ex-wife 38 billion. Okay, IRRs. It's real money. Differences in IRR is real money. We all know that. Now, I'm going to talk a little also about project finance in Africa. And here's the problem. EPC contractors, I want a risk premium. If I'm going to do a project in some risky African country or Asian country, I need a risk premium. I need a 20% more, 30% more. And lenders, I need a big extra risk premium for going into that country. Investors, that's what we're talking about, the IRR. Suppliers, everybody needs more risks. And at the end of the day, the amount you have to pay just starts ballooning. And why you really need a risk premium on an EPC contract or an O&M contract, or a loan, we got to talk about these. And instead of throwing out BS, you got to talk about really what's causing the risk premium. Okay, so this is, I don't know if I really need this slide. Enough of that one. Okay, let's talk about EPC or O&M. Okay, now, IRRs for there is a real country risk. But whether the risk of drinking beer or drinking coffee or eating chocolate is higher in Nigeria than it is in London is another story. The government, yeah, okay, I don't deny that there's risk there. For an EPC contract, think about where risks come from. They're errors in estimating your cost, in estimating your timing of your cost. If you have to wait to get the costs back, all of these things. Where is the country risk? Where's the country risk in an EPC? So I did this with my class a little. I said, okay, in one example, and it happened to be a real example, in the DRC, they were building some kind of equipment. I better not say what. There was no liquidated damage. If there was a delay, there wasn't a liquidated damage. If there was a bad performance, there wasn't a liquidated damage. They bought the equipment and just put it in. There was not big variation in cash flow. There's a little possibility in change orders. So that's one project. Second project is in US. There's a big possibility of cost overruns. The off-taker is going to be really hard to deal with. They're going to give you liquidated damages for delays, performance. They're going to have a big retainage at the end. So if you have a delay, they're going to argue a lot about change orders. And I asked, which of those two projects would you need a higher, if you say, okay, as an EPC contractor, I need to make 20% above my costs. I don't know where that 20% comes from or anything else. Which one would you have to charge a higher profit percent for? And they said, well, of course, the DRC. What kind of crap is it? It can't be the DRC. Well, if you are in the middle of a progress payment and the government doesn't pay you, you can say goodbye. I paid for, I don't lose anything. Goodbye. The risks don't come from political risks for the EPC, and the same thing, they don't come. You just leave. I know you can say, no, there's retainage and all that. Okay, there might be some, but just putting arbitrary risk premiums on this. And what about an O&M contract? I didn't put that in. Let's say you have an O&M contract with XYZ country and another one that has big, risks in for liquidated damages, big variations because it's unproven technology and all that. And you have two O&M contracts, and one's in Sierra Leone and one's in US. You're going to say that the Sierra Leone has a much bigger risk. If they don't pay you, you leave. How can you put a risk premium for a country? I know that doesn't really happen, that you leave very often or stop in the middle of a contract. I know that doesn't happen, but theoretically, that's where political risk comes from. I'm shouting a lot, but it comes from breaking a contract. It comes because you say, oh, this country doesn't have good contracts. Fine, if it doesn't have good contracts, but then you've got to look at the consequences of default on a contract. I've got to relax. Then you can, now I skip to Africa. Why did Aqua Power bid on a project in Ethiopia and bid 2.5 cents for? So nobody knows what kind of IRR they were getting. You know a little bit that the World Bank was ripping them off like crazy with this risk premium they charged. Sorry to the World Bank people, but they charged for a standard kind of safe project, they charge something like 4 or 5% or 6% credit spreads on this. The real reason Aqua Power would have won, or NG, hopefully they got it 3.8, still not that low, but it was a while ago, is because they're accepting a lower IRR. That's what I believe. Interesting that where they're from, by the way. And then I go through other cases. I go through, okay, this is a barge project in Lagos. I call this a Christopher Columbus project. I've gone through this before. They charged at that time the cost of a new turbine would have been somewhere between 250 and 400. They had a used turbine. And then the gall of this Stanford AES saying this project was an example of how we work together with countries. What you're doing is stealing from them. Oh, I didn't put the 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 capacity charge was 200. You would have got a payback of 1 year basically on this project. Now here there is risk. Okay, I'm going through this, and then I'm going to go through getting our nice man Damodaran. I'm getting his data and showing you how the IRRs really work and how the risk premium really works. Ghana, they didn't pay their companies, and now they're cutting the PPA rates by 15%. So, oh, yes, there is risk. Eskom in South Africa, they're bankrupt. Nigeria, the off taker is an NBET, Nigeria Bulk Electricity Trader, and they get their money from the distribution companies, and the distribution companies are all basically not getting paid anywhere close to their cost. So how in the heck are they going to pay you back? And if you look at the history, ancient history, but this is S&P put this thing, and if you look at all these places like Dabble who didn't pay, it's always that the state didn't refuse to pay. So you can say, ah, look, there really is political risk. Then you look at more recent projects. Now all the defaults really happen in the US, the UK, Argentina. Well, maybe that's political risk. China, what happened in Argentina? That's a transport. Australia, Cayman Islands, that's US or UK. Okay, that's where the defaults really came from. They came from a lot of merchant plants and other things, whatever. And then if you look at this kind of thing, this is another report from S&P. You can see how much of a portfolio they have versus how much defaults. Western Europe, only 27% of defaults for 47. Pretty good. Same thing here. A little bit more defaults, but still less than the ratio, I guess, is the really important one. And then you look at Africa and the Middle East. Now, who knows how much are in the Middle East or Africa? This is by far the lowest ratio of defaults to loans down here. Latin America, that's a little worse. US, very bad, of course. And then why are you going to say that you have to put these risk premiums here in Africa? Where's Asia? Oceania? Asia, a little worse. Yeah, who knows who's in Asia? Yep. Africa, best. Okay. Oceania. Okay. Eastern Europe, a little better. Okay. That doesn't have anything to do with Damodaran. Here's another case I had. Here, this is they were going to get an EPC, engineering, procurement, construction, and I should know what that is. I have no idea. The cost is, you can send me a thumbs down and say I don't know what the hell I'm talking about. Good. The cost was 29 million, the EPC cost. The company went through and got all the little quotes for all the equipment and all that, all the stuff that actually worked, went through, and they got 19 million. 20, this is in Rwanda. 29 million, 19 million. 29 million, 29 million compared to 19 million. That's the amount of the cost. That's the amount of the cost, the profit that they were building into this. It was something like that. Now I went, and I'm not making a video on this because it was kind of BS. I went and I said, look, let's look at the EPC perspective, and let's understand really where the risks come from, and let's make some base cases, some worst cases, and put some probabilities in and get an expected value. And then so we can make some other hypothetical cases where we have higher variation in cost or lower variation. That's where the profit should come in, not some arbitrary risk premium. And then I said, okay, you can add things for down here. I made my little stupid little graphs and said, okay, we can put in some S-curve risk. We can put in some retainage risk, we can put in some liquidated damage risk. That's how you should that's how you should theoretically come up with your profit. Here, and I put some more stuff in. I put the file at least on my website somewhere, and tried to gauge that. Now, when we look at risk premiums, let's look at a couple of other things. This is some thing, who knows? This is supposed to be IRRs of funds. So who cares about the upper quartile? Let's put the here's what do we have? What do we have? Where's the scale? Where's the scale? Oh, S&P. You earn 2% or 7%? 7%'s a lot. That's historically that's enormous. Even if you adjust it for inflation and everything else, it's enormous. And they said, okay, if you had a buyout fund, you get 11% or 13%. That's also extremely high. But then we're going to look at country risks, and we're going to see that the country risks are higher than the leveraged buyout investments and the NASDAQ and everything else. This upper quartile is meaningless. Lower quartile would be more interesting, okay? And we can protect ourselves with letter of credits in these countries and everything else. And we're going to open this. Here's some of the risk premiums. 10% for these countries, even 5% is so enormous. So enormous. 4%. Of course, USA has nothing. France has a risk premium. Okay, Japan. This is ridiculous. Absolutely ridiculous. And then one way to test this, if the risk premium is higher, and if you, for some reason, drinking beer in Tajikistan is so much more risky than drinking beer in the USA, then you should see a much lower PE ratio for all the companies, because of PE ratio, you have growth rate and returns and cost of capital. Cost of capital is an enormous driver of the PE ratio and the price to book ratio. So you should see dramatically lower PE ratios for the countries if you're selling food or toothpaste or housing equipment, whatever you're selling. And here they are, and here you see, maybe you could get a little bit here, the 10 to 15, and these ones are a little bit higher. Maybe Brazil is a little bit lower than US, so you could say, it's got a higher risk premium. Who knows? Who knows? There's no overwhelming evidence. Maybe these countries have a little bit lower. Who knows? And then you can do the same thing. Price to book ratios might be better because price to book ratios are driven by the return versus the cost of capital. Okay, and there you see less kind of evidence. You'd see the highest one in green, kind of here. Venezuela as the highest one. Some countries in Africa. We'd really have to look at country by country, and I'd love to have the time to really study this. Take the PE ratios, take a similar industry, a similar growth prospect, a similar return profile, and see if you can back in to the cost of capital, which is how it should be done. I talk in other videos that CAPM is such bullshit, it's unbelievable. I'm sorry to swear so much. But it is just total and complete rubbish. Equity market risk premium of 5% is totally rubbish. Total and complete rubbish. To get the cost of capital, the best way I think is to dissect the market price to book ratio, pull it out. You can take the price to book ratio, that's a return minus growth divided by cost minus growth. You can back in and get what the cost of capital is from the price to book ratio if you put a return and a growth rate in, and you don't know those two variables, but those two variables are a lot better to know than the equity market risk premium bullshit, the beta bullshit, the risk-free bullshit, which is 10%, which is a 10-year yield that has tons of inflation risk in it. Come on. What kind of science is finance? My God. And then I just did a little scatter plot. And you don't, if this was really true, then this is the country premium from Damodaran, and this is the PE ratio. You would expect the PE ratio to be no, this is the PE ratio, excuse me, and this is the country risk premium. So when you had a much higher country risk premium up here, you should have seen a downward sloping, clear downward sloping curve. Of course, you don't see any. Okay, and then this is the best of all. You look up Damodaran's country risk premium, and there is some Lutz Andrus Loflu and Gerald something, and they did a critique, and I got to show you the next part. And this is what they had. This is how you compute the risk premium. This is what you do. Oh my Jesus! Oh, and this means something. Oh my God! And they said, oh, basically, yeah, it's okay. Now let's really talk about it. So now I'm going to go, and you can see I get a little bit emotional. I'm going to have a heart attack. God, I just looked at myself. I look so goddamn old. We're going to just make a little bit of a simple financial model. And I'm going to start with all equity, and then we'll put some debt and equity here. And let's make a 30, let's start with 0 and make a 30-year project. Alt-EIS, tab, 30, enter. Okay, and let's first just let's put minus 1,000 as our outflow, and then let's put an inflow here. I hope you're not hearing my people scream on the television. Okay, and the inflow, let's say that we have 100, and let's not even inflate it. Let's just put it here, and then Shift Control R instead of going blah, 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 blah. Okay, and then we have our net cash flow. Okay, and now we're going to put different risk premiums in and put different target IRRs, and our net cash flow is just our inflow minus our outflow. It's how much you take out of your pocket compared to how much you put in, and I was an idiot just here, and we have to add this together, and then we're finished. And then we get our IRR. And anybody who criticizes the goddamn IRR, oh shit, this IRR is bullshit. Okay, I know there are problems with IRR. Everybody knows there are. Everybody knows it's got the reinvestment rate in and everything else. These academics or the CFA who say you have to use NPV because of that, or because you have this occasional problem when you have two IRRs, which you do have occasionally. I just ran into it with my friend. Oh God, what's his name? Whatever. That's our IRR. Now, if we put a target IRR, let's see in right now, my friends tell me that you have a risky project with merchant risk, offshore project. They want to get something like 5% IRR with absurd kind of assumptions on O&M, on capex, on risk, and everything else. And then we put the NPV. And anybody who doesn't know that the NPV and the IRR give you essentially the same thing, but the IRR is a way to is a way to just compare different projects. Come on, this stupid argument between IRR and NPV. How irritating is that? And then you over here, I'm gonna get this wrong, but let's put NPV result. And then let's put up here our amount we're charging the country, the price. Okay, don't forget that this IRR is not something that's just comes from nowhere. It comes from charging people more for beer, more for chocolate, more for electricity, more for toll, more for healthcare, more for education. That's where it comes from, and it goes to the pockets of the people who are making the investments, who maybe are the people who are watching this video. So I'm just going to lose all my business because I'm moaning about this. Okay, and then we we go and make a new macro. Oh shit, let's just record it maybe. Let's let's go to the data and what if analysis, and we'll do a goal seek, and we'll set the NPV to 0 by changing the price up here. Okay, and let's press OK, stop recording our macro. Let's go and press Shift Control C. And now let's put a button here maybe. How about this? I'm gonna put a spinner button around the target IRR, and I'm gonna put this as 5, and I'm gonna maybe make a new sheet here. Okay, so I can use our windscreen wiper method, go to format control. Let's go up to 30% from 0% and go to another sheet, back to this sheet. Click on the 5. It changes it to 0, change it back to 5. And then let's do this. Let's press F3 and paste our little list of arranged names, and then we can take this, copy this. Hopefully, I don't know if I did that right. Go into our macro. Uh-oh. And can I copy those little arranged names here? Oh, okay. I don't know if I copied it. I just didn't. Shit. Uh, okay, sorry. Oh, God. Okay. Why didn't that work? I copy that and I paste it up here. Okay, so we're going to make the NPV result, that's going to be 0. So we're going to put that right here. And we're going to get the price. And we're going to put that right here. And then we'll delete the rest of this crap. Okay. And then what we can do is right click on this button and go to assign macro. And I've done about a ton of videos on this, and I forgot to make this thing equal to that divided by 100. And now we see what kind of price we need. Now, to really see what an IRR is, you can make a little, to show you that it's a growth rate and to shut up some of these academics, and we can add our refinancing reinvestment. And then we can put a little, add the dividends. That's how much we get. Put our closing down here. And we don't start with anything. We'll make our opening equal to our closing. And then on this one, we'll put the IRR itself in here. Let's use this IRR in case I didn't do it. And we'll take the opening balance and multiply it by that IRR. We'll get to put our dividends in our pocket up here, and Shift Control D, maybe Shift Control C. Oh shit. And then the opening balance plus the reinvestment plus the closing balance is what we end up with. We press Shift Control R, Shift Control C, and we go to the very last, up here, let's go to the very last 30 years. So we go up here and we put a last ending cash. That's like that Amazon thing. And we put equal X lookup. Beautiful. Somebody told me X lookup. I wish I would have remembered who did. And then we can put in, just like we're using lookup, go to the closing balance, get it. That's how much we're left with. Okay, and starting investment, and we put our investment of our outflow, and then we take the divide that, okay, and then we raise that to the power of up up 1 divided by the 30 and put minus 1, and we get exactly our IRR. If you don't believe it, let's put a 10% IRR. Now we get 17,000. Let's put it down to the European, and this is the big deal, is you get only 4,000 compared to if you, then it goes up to almost 6,000. Then it goes to 7.6 thousand. We started with 4,000. 8 is 10,000. You're not only doubling it, you're by a couple of percentage points. 9 is 13,000 compared to what was it again with 5,000? 19,000 for 8. When you this Damodaran puts his stuff in, if it's 4, you only get 3,000. This difference is big. That's why when you put wax in that little data table with corporate finance, it's an enormous difference. Okay? And maybe we'll make a little table now. So when we start adding this stuff into it, it makes a very big a difference in real money to pay your grandchildren off. And I have grandchildren. I know if I make an investment, I want them to, go to whatever, some university so they can learn bullshit about Damodaran risk premiums. So let's go to Google and let's get it. So let's put country risk premium in here. Did I spell it? Not country music, country risk premium. Okay. And there it is. Oh, they define it. Country spreads, and there's Damodaran, there's NY Stern. It's all over the place. Oh, CFA level 1. They probably have even more bullshit on that one. Sorry, I'm swearing so much. I just can't help it on this one. What happens if we go here? Ah, there they are. So, and then this, oh God, if you look at this, the way they use CDS spreads, betas of the countries, some magic potion. When I thought about magic potion, I just think about this crap where they get it from. Just because a country has a risk premium does not mean that selling beer in the country has higher risk. Okay, so let's go and just plop this in. I'm not using my anything fancy. Okay, and I guess that's enough. And let's put a couple of columns in here and put a couple of rows, and let's put a scenario code or a country row. Okay, and let's put that as 1 here first. That'll give us Abu Dhabi, and then what they have is, I guess here, let's just put this as let's wrap our text around equity risk premium. So they when you go, let's go to the US, which is such a safe country where I've lost money on political risk, I assure you. Uh, you know, I don't know. I'm going to use this as the total risk. Now, you could put a risk-free rate in or something, and put a this we could put a 2% risk-free rate or something in like that. Yeah, let's do that. Let's do that. So right now, if we just put equal index, and then we go down to these ones, uh, and then put a comma and go up to the 1, then now I can just copy that in. And of course, I didn't press this F4 button, so I did that on purpose just to remind you to do that. No. And then we can have this. So now we can try different countries, and then let's go to our developer and just add a little box in for our country risk premiums. Okay, and go to uh, this one. I don't know why this. I bet you this Damodaran, he has students who will do all this stuff, and I don't have anybody who's going to help me there. And then we'll put, after you do this, you use these things whenever you have the index function. The drop down box is really a good one to use. Okay. Oh, good. Okay, we'll press OK. And now I strongly believe if you're going to apply this BS, this complete BS crap, if you're going to apply this, you should be using a risk-free rate that doesn't have inflation risk in. So maybe 1% would be high enough for that. And I'm not going to worry about betas and all that. We're just going to put in the premium. And the premium here is so the equity. Why is Bahrain so high? Uh, uh, let's use this uh, uh, country risk premium. Oh, you want to put a little bit high. The equity market risk premium. Let's put the equity market risk premium here for the countries. And we could also put in we could also put in whatever, some other, do it another way, but I'm going to put this the return. Okay. Somebody can yell at me that I took the wrong numbers, but we'll start with this. Okay. So what we can do with once we have this, this is our country. Now, usually when I don't do this, I don't bother saving the file because I just think it's such crap. But this time I will. This time I will. Okay. And then now what we can do is, instead of this number here, I'm going to make this thing obsolete. Goodbye to our little thing here. And I'm going to put in our equity market risk premium here. And then I'm going to right click. What's the matter with Bahrain? Oh, I would think that's a safe country. They just did a peace agreement. And then, so let's put, who do you want to try? Let me try. Armenia. I went to Armenia. I loved it. They were so nice. Now they've got a war. That's too bad. Okay. And then what? Well, I can't try Australia. That better be. That's the IR we need in Australia. Such crap. Cameroon, we need 14%. France, we need 6.9%. The country that's going through some political turmoil right now, this one, we need 6.23%. Okay? Uh, uh, and if we had a project for this country, 7.54, 74, but if we went to, how about Sierra Leone, that same project would be 195. Okay? That's the impact. We'd have to take that much money out of the people's pockets. That's what you're doing, Professor Damoradan. Okay, whatever. Okay, good. Now, if you uh, uh, click on this, let's click on this. So this is our model, cash flow. Okay, and these are our sheets, and when we're taking it from a different sheet, let's just make our little thing here. I'm not going to put any rows at the top, and I'll keep it in column B. Okay, The red one. Okay, those are our only inputs, and for some reason I didn't, when I take this number from a different sheet, why didn't it, oh, I put a tab color of a sheet. Okay, let's just make it a red color. Okay, now let's see what this really means. When, here is the deal, here's the deal, whatever that means. When you have the reason for political risk in Slovakia, we have this much versus, let's see what we have in Germany. What's they say that Germany has a higher required return than US? Whatever, it seems to be the same. When you have a higher, the reason you have this political risk is not because of all our EPC contracts. It's not because drinking beer in Nigeria is riskier than drinking beer in London, that people will stop eating chocolate when there's a government turmoil in a country. It's not because of that. It's not because there's higher volatility in cheese sales or milk sales. There's no higher. It's because the government might break a contract. That's where it comes from. I wish these people would start thinking about where risks come from instead of making their little magic potion. You can't see me shaking my arms and making a little picture of magic potion, but that's what I'm doing. Okay, now if we want to do a contract analysis, just like a loan is a contract, we look at the probability of default. And the probability of default, let's put in as 60%. But then after you have a default, like in Ghana, when they are delayed in paying their PPA prices on electricity, we all know that, at least for the government-owned projects, maybe not for some and maybe more for others and whatever. There's, at the end of the day, they settled on a 15% reduction. At least that's what I understand. It could be wrong. So once you had in that case, the loss given default, and we can use this basic thing from banking in any kind of contracts, that would have been 85%. No, 15%. You lose 15%, but and you get back 85%. The recovery is 85%. And then this very much will depend on the year of default. Now, when we do all of this, and I'll put year 3, okay, and perhaps I should have, like we always do, we probably should have moved the timeline up to the top somewhere, okay? And then we better put a freeze pane, Alt WFF, okay? And then now if we want to do this coloring, we could put, 2 periods up here at the top. Click on that, make a color. Okay, and now so we have some potential default, and the way we can do this is let's start with Germany. Good, Germany, and let's put maybe Germany. Let's stick Germany up to this one. Okay, and now we can then say, okay, now I would love it if instead of you giving me a stupid little thumbs down on the video because you like political risk and you want returns, or tell me what's wrong with this analysis. Tell me what's wrong with it. Tell me if I didn't compound something correctly. Tell me what I'm doing. I'm using expected value. Some people can say expected value is no good. Like if you have the probability of default on a loan times the loss given default, you can say that's the credit spreads. Credit spreads are actually higher than that because any bank, if you just caught expected value, then you'd kind of have a losing proposition. You wouldn't make any profit. If your credit spread, the amount you earn, is just some kind of average of the of the probability weighted average of the defaults and the amount you lose after default, you need a premium on top of that. Who knows how much? That's another fascinating problem in finance, and I wish people would kind of do that. So now we can, let's first put uh, uh, the the cash flow. Uh, I better do this. Cash flow without default, and then, and I've done this many times, and then but cash flow, I'm just, making kind of some of this over and over again with default. Okay, and then we put our expected value here. And then so that's going to be a weighted average. So if we take, there's a 60% chance of default, we put our cash flow with default down here. A cash flow without default is 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 1 minus the default probability, and then we'll just take a 60% of one times the other, and then we can get our net cash flow. Well, we can get our IRR. Okay, and we could also, I suppose, what we could do is it almost is kind of irrelevant. We could put our opening balance, add the cash realized. I'm debating whether we should do it with and without default. We can just put the expected closing balance and see how much we, at the end of the day, how much cash we actually get with this different IRRs. And then we'll make some kind of table that says we're going to back into this default given these numbers, or back into, yes, we can make a little table of what kind of, uh, with different years of default, and we can make a little table that says what's the break-even probability of default or loss given default. I think. I haven't done it yet, so I'm going to screw up. Okay, and then let's put a little flag here for post default. Okay, or pre-default. Let's put pre-default. And so if the default happens in year 3, if we'll just put, do our standard kind of thing here, we'll put a number up here and put less than this number. Okay, Shift Control R. So if it's before the default, if we have no default, well, we just get our cash flow. Okay, and our cash flow is this amount. Okay, but if we have a default, we say if it's the pre-default, we just get this amount. But if it's not the default, we get this amount multiplied by 1 minus we get 85%. And of course, I've got to put this F4 in, okay? Shift Control R. Okay, now that's way too low. I'm going to put a 60% loss given default. So that's what we have. And then our expected value is this one times the F4 plus this one times the F4. Whoops. Oh, I pressed F5 by accident. That F4. Okay, so that's the amount we get. Now, let's say we're going to compare this. Let's use uh, I wanted to compare this to the return we're making. So let's first put a country in that's got a high probability of default. Let's go and put Jamaica. Oh, that's not so bad. Oh, that's Japan. I thought, why is Japan higher anyway? Okay, Jamaica. Okay, so now we need 145. We need 145 if we're in Jamaica. And that means that at the end of the day, after our expected IRR in Jamaica, after we did this, is equal to, oops, I'm going to put we better put in year zero, we better put our amount in, right? Um, okay, and then our expected IRR is just this number, okay? Which is a whole lot higher. It's a whole lot higher than the German IRR. How about this? I'm going to put up here, let's see if we can do the same thing. Let's put USA IRR. And let's put this, and then let's go down here. It's got to be somewhere down here, right? This is the 5.23. Okay, and then we could put down here the NPV at USA IRR, and that's just NPV, of course. Okay, oh no, I didn't use XNPV. This one, okay? That's our NPV. And then we can do another goal seek. And on this goal seek, we could back in. Let's put 80% loss. And let's put 2 years. And then we can say, okay, let's just back in, which is some very negative kind of assumptions. And let's put in those negative kind of assumptions. Let's do another goal seek. I'm going to maybe make another macro. So I'll call this goal seek 2. Eventually, I'm going to have to name the ranges and all that stuff. And let's make this one 0 by changing this probability of default. So let's go to a data, what if analysis, goal seek, and let's make that one to be 0 by changing the probability of default. And that says, in that scenario, this implies, even with an enormous loss given default, I better stop the recording of the macro, and even with a default way up in year 2, we have got get some words out. We've got a probability of default of 72%. Let's just do this for a moment again. Now I don't know. We could. I'm not going to do this last thing because do we put the reinvestment at the the up here the 14.2% rate, and we make some reinvestments and some probabilities of loss and get some different ending cashes. I should do that. But what I'm going to do is let's make a little table here. And we're just about finished. And I hope you get the theme. The theme is that these implied probability of defaults are absolutely ridiculously absurd. Now you can say, oh, no, 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 no. He means an investment that's only 5 years. Oh, that's what he means. Well, if you're investing in a chocolate company, a beer company, any kind of corporate finance, that's forever and ever. So take corporate finance off. If you're investing in any kind of project finance, it's a long-term investment. What kind of investment just completely stops forever and doesn't have a terminal value and doesn't have a discount rate in a terminal value? So I'm going to leave it at 30. You could do a sensitivity analysis on the life too. But let's put the loss given default, and let's say we start with 10%, and let's go down here and put Alt EIS and put 0.2. How's that? Uh, let's put 0.1. Okay, so that's our LGD. And let's put up here our year of default. And let's put that as 1. I think if we put 1 up here, yep, up. Oh, come on. I don't know why this is going so slowly. I hope it's not, I haven't mucked up something. But if we put 1 up here, not here, 1 here, then it's defaulting in the very first year. And if we go to our developer tab and go to our macro and we say, okay, we better run it, then the default probably is a measly owns 68%. Okay, so we can default in different years. Let's Alt-IS again. Oh, what happened there? Okay, must have done something wrong there. Now to make, when we make this table, we're going to have to do a goal seek each time. We're going to have to do our little goal seek each time. And the very first thing on the goal seek, we better put this NPV country risk premium. How's that? And then we're going to put how about this? We'll go up here and make this one the probability default. Okay, and I hope I can remember these. And then we'll make one more range name. So we're going to make a little data table. And on this data table, we'll call this table out. And maybe I'm so bad. I'm so old and so decrepit that I better put these range names here so we can remember what they are. Okay. And then let's copy these and go into our macro. Okay, so the rest of this is going to be a macro. You can fast forward this if you don't give a crap about the macros. Okay, and oops, it looks like what I have to do, I just learned this, see? Looks like I have to have it open, then copy this, go to our open one, and then go down here, and maybe let's put it at the bottom, okay? And let's put a sub and call this a table, okay? And then we're gonna move all of this stuff up here. Let's do. Come on! Why is this so slow? Damn it! Okay, because I want to get through with this video and it's getting long. So we want the NPV of this result up here, and we want to change the probability of default over here. Okay, and then now let's just, we don't need this anymore, this anymore, this anymore, and then this table output we're going to use down here. And what we're going to do is we're going to go around the table output, and hopefully I can do it fairly quickly. And we can put rows, and we can't put, I'll put table rows equal range table out, and then you have to be careful, and you put dot rows dot count. Okay, and then you can put the same thing for columns. How's that? Okay, and then once we have that, that's going to be a big deal, because then we can go for row, and then we need start row and start column, and I think let's just put table table rows. How about start? Now you might think, God, but you have to do this with a macro, because columns. If you don't do this with a macro, you're going to get really messed up, and then this is going to give us up here. This is going to give us what's inside the data table. Okay, but we need to go up one row and back one column. So if we go to row start and we put that's going to be our what we're going to change, and we're actually also going to need the year of default up here. Let's put that and remember what we have. Okay, I'm hopefully I didn't really explain it, but uh, 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 what I'm going to do is first put year of default. Okay, now let's put this start. We put row, and then I think you don't put dot count. So this gives you the starting row and the starting column. Almost in Excel, they should say that it's the starting row and the starting column. And then you put for row equals table rows start. I made maybe 2 table rows, and then uh, uh, plus. No, you don't do it like this. You put 1. We go from 1. Okay, and then we'll put 4 column equals 1 2 table calls. Okay, and then we can up here the year of default range for the year of default. That's going to be the column, right? That's going to be, I'm sorry, that's all on the top. So we put that equals cells, range, table out dot cells, and then you've got to be careful. That's going to be cells, and it's going to be, the row is going to be the table rows start -1. And then it's going to be the column number from there. And just a minute, and that's not quite correct. I've got to pause for just a second. I'm not sure that column is right. I'm gonna keep going. I tried to hurry up too much, and then I'm gonna put cells range output, and then table out dot cells, and then I'll put row comma call, and then I'll put equal range probability of default. Okay, and then we'll put next call first, and then after that, next row. Now, the other thing I didn't change is I need to go up here, and we're going to put in the LGD. So I'm going to put range LGD. That's the loss given default equals range, and then we'll take the same kind of thing. We'll take this tables out, but we'll do it kind of the other way. So that remember that LGD is along the column. So we're going down the rows, and we first put row here, and then we put table columns start -1. Okay, and now I have a big dilemma. Should I leave the thing on? I'm going to turn the video off because it's probably not going to work, and then I'm going to show you the errors I made. Okay, all right, so we'll just give me 1 minute here. Now I put the range name in and I ran it. I swear to God I didn't change anything except putting the range name in. And now I forgot to do one thing, and that's what I meant to say at the beginning, and you kind of saw that I should put this goal seek in here, or better yet, let's get rid of this crap here. I don't know why it starts doing this with the goal seek all the time. I should be able to tell you that. I cannot, because I don't know anything about programming, if you want to know the truth. And then I put goal seek 2 here, and we'll just put that down here, and we don't now have to put, all this fancy little stuff in here, so we're going to run the goal seek each time. And then if the goal seek fails, that's too bad. So let's run this button. And what it's doing, it's giving us, and if the probability of default is more than 100%, that's kind of ridiculous. And it's running and running and running. And should I turn off the? Oh. Okay, I did make some mistakes. I knew I would have done that. Sorry about that. That I shouldn't have put this one with the table out. It's just cells. You go to the row and you start at that row -1, and maybe all this table row start should have had a -1 in there and all that stuff. But you start at the row number, and you go to the top and you put this is going to be 1, so you start with -1, and then keep the column start -1. So that's going to go through and put the loss given default in that table, blah, 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 down the rows. And this year of default, again, this is hard. I didn't explain it well, and I apologize for that. We don't put the output in. We start with the rows. You keep that rows at the same. It's always the rows that you start with at the top of the table -1. And then you go around the columns, 1, 2, 3, 4, 5, 6. But when you go around the columns, you have to make sure and start at the right column. And that's that table column start -1. And I'm sorry about getting all that wrong. So let's see if it still screws up. So when you do this, it's going to give you these numbers that are way above 100%, which are meaningless numbers. And then you can kind of look and see what the probabilities of default are with different LGD and different year of default, and you get absurd numbers. You get completely absurd numbers. Now, we could put debt into this thing, and I'll make a second video and put debt into this thing. And now what we can do is let's change it from Jamaica, which is a place I love. What happens in Jordan? In Jordan, we've got 12%. Let's in Kenya, we've got 14%. Oh my God. Korea, that's the Democratic. Laos, 7.99. That's not so different than our 5.23. So it's just a little bit higher. So let's run and I should name these things. This is just the goal seek button, And we're just going around. Oh, good. You can kind of see how it goes around. And then it's giving you just with only that's about a 2% risk premium or something. It's giving you the probabilities of default given the year, and they're still big. For me, these are still enormous probabilities of default. This is to run the table. Okay. Okay. And this is just our little goal seek. All right. I hope I hope I'm not being mean to Mr. Uh, Dam Damor Dam Damoradan. Damoradan. I hope I'm not being too mean to him, but these are dangerous. They're really dangerous. It's a serious business. It increases the costs of these projects dramatically, and it just transfers money from countries in Africa, for example, to New York or London or Paris. These places are rich enough. Why do you have to have this transfer for this mythical probability of default? And please, this is if you have a government contract. If you don't have a government project, the whole idea is to think a little more openly, have an open and less bureaucratic mind by just saying, we got to go to the Damodaran website. Enough of this video. No, enough of me shouting. I got you all pissed off at me.